As the value of a single Bitcoin approaches $100,000, we have some exciting news at the intersection of politics and crypto. President-elect Trump's team is reportedly holding discussions with the digital asset industry about creating a new White House post solely dedicated to cryptocurrency.
Yeah, and while the White House debates the creation of a cryptocurrency czar, the president-elect just nominated crypto-friendly Howard Lutnick to be his new Commerce Secretary.
The GOP under Donald Trump promised to be a crypto-friendly party, but these recent stories seem to exceed the wishes of even the most optimistic crypto enthusiasts.
All right, joining us to explain it all, fund manager and author of Planet Ponzi, Mitchell Feierstein, plus economist from the American Institute for Economic Research, Peter C. Earle. Gentlemen, good to see you both. Mitch, let's start with you. Do we need a crypto czar in government? Is that the era that we have entered into?
Well, yeah, I think, look, Gary Gensler failed us. He gets an F- on his crypto efforts. So I think we need somebody that understands it. I mean, it's a very wild emerging market. So the volatility is extremely high. You know, if you can stand the extreme high volatility, I remember when it was trading at $100 each. Now we're at $100,000 each. So the stability is not there, and there are alternative asset classes to look at. What we don't want is a government digital currency that they control everything, because that's the end of people's freedom.
That kind of defeats the entire purpose. Exactly. Peter, I want to ask you about this. It's not all good news on the horizon regarding the economy, especially for home buyers. It continues to be really tough out there. At noon today, Freddie Mae reported the average monthly mortgage rate has increased to 6.84%. Can you explain why mortgage rates are back up to almost 7% in a reversal of some of the recent declines? Again, this seems like this should be a number that should be going lower. Do you anticipate it will as the Trump administration begins its second term?
Well, it's difficult to say. I mean, we would think, or one would typically think, that interest rates would fall as the Fed is easing, but actually mortgage rates are following the Treasury market. And the reason why we have this difference is because the Treasury markets are reflecting more risk in the economy. We've got inflation is still high. The disinflation is not increasing the way it was. And also we have a housing market that's pretty much out of whack. We actually saw for the first time since July 2021, we saw existing home sales rose, but at the same time, we found out last month a decline in housing starts. So the mortgage rates are following a number of disjointed economic developments, and it's going to be some time probably before it becomes a little more predictable.
Speaking of treasuries, we also want to make note the bond market is forecasting less rate cutting by the Fed based on their assumption that inflation, unfortunately, ladies and gentlemen, is far from over. This could be, though, good news for oil and gold investors, but bad news for the regular average American struggling to make ends meet. Mitch, what say you on that?
Yeah, I mean, I think it's very difficult. I think gold is a currency, and people need to look at it like that, but the bond market is telling us a different story than the Fed. The Federal Reserve, as I said before the elections, was political with their rate cuts. The bond market disagrees, and that's why rates are headed higher, because there's still inflation and we have a lot of risks out there, geopolitical risks, to add to everything else. House prices up 50% from 2020, making it for first-time buyers and everybody's children and grandchildren impossible to buy a new home and enter the property ladder, which is what we need to do, and hopefully the new administration will remedy and right the ship.
Yeah, hopefully get back to that American dream. I expect that so many people are not able to get to these days. All right, Mitch Feierstein, Peter C. Earle, thank you.